So we're coming with a couple of news in the box for the current market week. Of course, Godwin Emefiele, the central bank governor, used the weekend to add to the news cycle, talking about the likely monetary policy easing when we have disinflation and if the cooperation, coordination, and everything else work between the fiscal and the monetary authorities. But of course, the budget was the big elephant in the room. Last week, then the president touched on a number of issues. So if we take all this news to Broad Street, how do we invest them? Since the earnings are largely out. So what are Omotola Bimbola and the rest of his team thinking when there's no earnings to analyze? You are left with news. And news comes first. Good morning.
Morning, boss.
It's good to have you.
My pleasure.
So news is king. There are little or no earnings to brood over. So what are you guys thinking right now? Who are you thinking of? Who are you analyzing right now? Are you analyzing the budget, or you looking at the downgrade, or you looking at the Euro bond, or perhaps the green bond?
We're looking at all those factors to start with, because after the earnings season, typically analysts tend to focus on macro drivers, of the business cycle, as well as of the of companies as well, in analyzing company fundamentals and the outlook for both the equity and the bond markets. Over the last 2-3 weeks, we have seen some developments in the macroeconomic space, particularly looking at the 2018 budget that was presented by the president last week. Expectedly, the president the fiscal authorities are proposing yet another expansionary fiscal year for 2018. If you look at the trend of the budget since 2014, they have been proposing expansionary budgets year in, year out. But the main issue for the markets is how do they intend to fund these budgets, these budgets, looking at the fact that revenue has been quite challenged because of the low oil price environment. So for the 2018 budget, the president is proposing to spend 8.6 trillion naira in expenditure. About 6.6 trillion will come from revenue, and the rest, about 2 trillion, will be funded by borrowings, essentially borrowings as well as the privatization of non-oil assets of the federal government. So for us, expectedly, the federal government is proposing to borrow less from the domestic markets in 2018, and this is in line with what we saw earlier this year when the DMO came out to say that the federal government now has a plan to reduce the level of issuance of domestic debt in favor of foreign debt in order to reduce the interest expense paid by the federal government on its debt obligations.
And we see that in Q4.
Also, that's in Q4.
The total Q4 is much, much lower.
Correct. The DMO bond auction calendar for Q4, they propose to spend about 20% less than, they propose to borrow about 20% less than what was borrowed as of Q3, and we saw the impact in the bond markets as well, because the bond market was entered the bull run about 2 months ago, which ended last week following the Moody's downgrade. So we saw average yield on the sovereign benchmark yield curve declining from over 16% to 15.2% as of last week. But last week we saw a change in that performance because the market was witnessed some selling pressure, both on the domestic sovereign debt as well as the external debts as well, which we can attribute to the downgrade by Moody's of Nigeria's credit rating from from B1 rather to B2.
To B2. So if I'm looking at the news right now, I'm not looking at the budget, and this is the time of the year when all these are coming through. What typically do local investors, we may start from there, want to look out for at this time of the year? Are they in the mood to claw back a little bit from their portfolios, whether it's bond or fixed income or the mutual funds or exchange traded funds or products? What will inform what they think at this point in time, though they have expenses, but they will still want to invest for when they see the future?
Correct. Actually, since April 2017, we have seen a tactical shift in allocation by fund managers from the fixed income markets to the equity markets because of the macro news-driven rally we saw in the equities markets. But now we are in November, almost in December, and this is a good time for most PMs to really look at their portfolio and make some, readjustment before the year runs out, when they have to report their filings to the SSA. So for us, We think that with the expectation of easy monetary policy by the central bank in 2018, because we have seen sizable improvements in the main anchors of monetary policy in Nigeria, exchange rates and price stability. So the central bank sort of have a clear road now, a clear path towards easy monetary policy in 2018. So this might be a good time for some fund managers to lock in longer duration bonds in expectation of lower interest rate environments in 2018.
How soon is it likely to come? It's not going to come next week. Not likely.
Definitely not next week. Not next week.
So we're looking at, is it January or March at the earliest?
We are looking at between Q2 2018 and Q3 2018 because even as much as the CBN wants to ease monetary policy to support business owners as well as individuals who want to borrow money to spur growth in the economy, they also have to consider their main anchors of monetary policy, exchange rates and price stability. On the price stability front, we have seen inflation rates, moderating from a peak of 18.7% in January down to about 15.9% now. However, the decline in inflation rates has been underwhelming because it has fallen, lower than what analysts had expected. So if you still look at the real rates of return in the economy, we still have the inflation rates still above the benchmark interest rates. So until we see the impact of high base effects leading to a stronger moderation in headline inflation, let's say by the end of Q1 2018, that will give the central bank a clear path towards easing. However, on the exchange rate front, I think we have credit to the CBN governor as well as the monetary policy hierarchy. We have seen stability in the exchange rate over the past 6-7 months, driven by two major factors. One, we have seen a rebound in our oil exports, driven by higher crude oil production as well as higher crude oil prices as well. And we have seen a pro-market move by the central bank, the foreign exchange market, with the establishment of the investors and exporters window in April 2017. So these two factors have led to stability in the foreign exchange markets. And if you combine the expectation of lower inflation rates as well as stable exchange rates, we should expect the central bank